Hey everybody, so I just wanted to make a video and talk about my thoughts on when we could see that big inflection on inflation. So right now I am on the EIA website. Now, just so you guys know, this is actually a legit government website. So it's basically called the US Energy Information Administration. And if I go down here a little bit, you can see .gov, government website. So now that I said that, the importance of this website is that it tracks a lot of data around energy. So we can see things like retail average regular gasoline prices. Now, if I'm looking here for the United States, we can see that this has only been going up. We are reading right to left here. So here in the start of May, it's just been going straight up. And right now the most recent is showing about $5, but I do believe this has come down just a little bit, and I believe it's around 4.95. So let's just think about this for a second. In May, we got some nasty inflation readings, and we're just looking at gasoline prices here in May. So this is all of May's gasoline prices. We were around $4.18 to $4.62. Now we're looking at June, okay? So June, it's $4.87 and it's $5 and it's $4.95. So we're coming in much higher for gasoline prices. So does this lead me to believe that the CPI for June is going to come in lower or much lower? Well, maybe it could come in a little bit lower, but I don't think it's going to come in much lower. I do still believe that CPI numbers are going to be inflated, and the no pun intended, and the year over year is going to be, like around 8%, like in that 8% range. So to me, I'm not all that bullish going into the next CPI print. And remember that we're going to have CPI, we're going to have bank earnings, we're going to have Netflix earnings, and then we're going to have all of the mega caps. Then we're going to have the retail earnings. So, this gets really, really volatile. And I do want to talk about oil inventories as well. So, on the same website, we can see weekly US ending stock of total gasoline. So now I'm going to scroll all the way down so we could get the most recent data here. Now, if I'm just looking right here, this is May, and right here we are in June. So this number is in thousands of barrels, okay? So here you can kind of see that we've been going down. So our inventories have just been going down, and that makes sense because our prices are going up. So, our inventory is going down means prices going up. So what I would like to see, I would definitely like to see, these inventories actually go up, and I would like to see prices go down. Then I would feel better about inflation. Now, I want to talk about another thing here. So if I'm going on the news and I'm looking at GDP, we are going to get this Q1 GDP reading on June 29th, 2022 for 8:30 a.m. Eastern Standard Time. Now, we're forecasting negative 1.5%. So we're getting negative GDP. And I would say that this forecast is probably going to be pretty accurate because if you go back in history, we get two preliminary GDPs before we actually get the final print. So the second preliminary GDP figure is usually going to be very close to the final print that happens at the end of the quarter. So what I think could happen here is that, we get that GDP print. Now, next thing you know, I mean, you just know that this is going to happen, that news outlets all over the world are going to talk about, the United States going into a recession. So basically, the technical indicator says that two consecutive quarters of negative GDP can lead to a recession. So, people are going to start saying, oh, we're halfway into a recession, this and that. It's in the bag. They're going to constantly berate Americans and say, you got to start doing this, you got to start doing that. There's going to be like lists all over the place. The 10 things you need to do to protect yourself from a recession, blah, 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 blah. So, they're going to scare the crap out of Americans. And I do believe that we're going to see demand destruction. And I believe, we could see that as soon as the CPI reading for July that happens in August. So that is when I'm thinking that we could see that first big inflection point to the downside. But here is the thing that I want to talk about. So just because inflation is going down does not mean that that is the right time to be buying. So inflation going down, what that means is that it's probably going to be because of demand destruction. So if demand destruction does occur, we're going to see that across the board on company earnings. So you have to remember what the stock market is. It's going off the value of what these companies can provide to you. So people invest in a lot of these companies because they're thinking that the earnings are going to be good and that they're going to continue to grow. But if we have demand destruction, then the revenues are going to go lower, the profits are going to be lower, earnings per share are going to be lower. So just because inflation is going down, that doesn't mean, hey, buy the dip. And you're probably going to see some misunderstanding occur. You know, at first, when that CPI comes in and there's a big inflection to the downside, there's probably going to be a massive rally. And, this is going to be a trap, I believe, because what's going to happen, in my opinion, is that we're going to see that demand destruction across the board on company earnings. And I believe that that CPI going down is going to be that bull trap that a lot of people get trapped into. So CPI going down is going to be great for the longer term, but in the shorter term, that means demand destruction, and that means company earnings are likely going to get hit. So I hope this video has really helped you guys out, and definitely favorite it so that if I'm wrong, you could come back and you could clown me and you could say, hey, guy, inflation didn't come down. You're an idiot. So definitely do favorite this video so you can clown me later in the future if I'm totally wrong, and enjoy your weekend, you guys.